Warren Buffett received up to $704 million from Coca-Cola stock dividends in 2022. The figure caught the attention of Elon Musk. You must be wondering, has a common man earned a lot of dividend? The answer is yes. Hayford Pierce, a science fiction and mystery writer by avocation, has topped the list. Hayford is known by the name of Dividend Millionaire. He was 53 years old when he analyzed his stock investments. He divided them into two groups. In Group A, he added about a dozen high dividend yield stocks, but slow-growing stocks such as utilities and high-yield bonds. The second group of stocks overlapped a little with the first. These companies were comparatively high growth, with a long history of increasing their dividends every year. All of them were well-known blue chips. Philip Morris was his largest holding by far. He then made a 30-year plan. He planned to increase the dividend payout by 10% per year for 30 years. Between 1995 and 2017, his dividend payments grew at about 8.54% per annum, short of his 10% goal, but it's been enough to make him a dividend millionaire, as his dividends alone have paid him more than $1 million. Of course, there's a built-in flaw to Pierce's plan, and it's his one major regret. He'd have a lot more income today had he been able to reinvest all those dividends. He said, "My underlying problem has always been that I didn't have enough other independent income so that I could reinvest my dividends. If I could have done that over the past 22 years, I imagine I would be worth maybe $10 million today." Before we proceed, let's understand what are dividends. Dividends are payments that a company makes to its shareholders. For example, say ABC Corp issues a dividend of 50 cents per share. Someone who holds 1,000 shares of this stock would receive a check for $500. Typically, a company will issue these payments based on its profits. When it has made a lot of money, it will distribute some of that among its shareholders. In the little book of Big Dividends, dividend stock expert Charles B. Carlson presents an action plan for dividend-hungry investors. Rule number 1. Don't compare dividends on stocks to the interest paid on bank CDs or money market accounts. The dividend yield, expressed as a percentage, is calculated by dividing the annual dividend per share by the current market share price. The yield on your money market account is the same as the interest rate. That is, if you put $1,000 in a money market account that promises to pay you $20 in interest over the next year, the interest rate, or yield, is 2%. This is the mistake most people make. They start comparing dividend yield with bank interest. They think that we should invest in a company whose dividend yield is high. However, it has two problems. Dividend yield is calculated according to the share price. If a stock price declines, its yield increases. We will come to the wrong conclusions. For example, if you are getting a $10 dividend on a $100 share price, that means your dividend yield is 10 divided by 100, which is 10%. But if its share price becomes $50, then the dividend yield of this company would be 10 divided by 50, which is 20%. And we would think that this is much higher than the interest rate of the bank. When stocks were crushed in 2008, the huge price declines lifted dividend yields to level that. Another wrong reason to select a company by dividend yield is that a high dividend yield is also not a good sign. If a company gives all its money in dividend only, then with what money will it grow itself? For example, in 2007, Thornburg Mortgage was a favorite stock of income investors because a dividend yield that at one point during the year exceeded 20%. The company went bankrupt in 2009, a victim of the credit crunch that annihilated many high-yielding real estate investment trusts. Investors who bought Thornburg Mortgage because of that big dividend and big yield lost their entire investment. Rule number 2, payout ratio. The payout ratio is a financial metric showing the proportion of earnings a company pays its shareholders in the form of dividends. For example, let's assume Company A has earnings per share of $1 and pays dividends per share of $0.60. In this scenario, the payout ratio would be 60%. Let's further assume that Company B has earnings per share of $2 and dividends per share of $1.50. In this scenario, the payout ratio is 75%. Comparatively speaking, Company A pays out a smaller percentage of its earnings to shareholders as dividends, giving it a more sustainable payout ratio than Company B. Obviously, if a company pays out more in dividends than profits, the dividend will not be sustained. If a company pays out a small portion of its profits in the form of dividends, there's cushion for the dividend to grow or at least be maintained, even if profits decline. A payout ratio of 60% or less is considered to be safe. It is said that the lower the percentage is, the safer the dividend. People who are generally concerned about the safety of their dividend income should regularly keep an eye on the payout ratio. Second criteria is overall Quadrix score. Quadrix ranks more than 4,000 stocks based on more than 100 different variables across 6 categories. Its firm has set up a free website, bigsfdividends.com, that provides payout ratios, overall Quadrix scores, and BSD scores for every dividend paying stock in the S&P 1500 index. There are 2 filters that you need to apply. Filter 1. Focus on stocks with payout ratios of 60% or lower. Filter 2. Narrow the field to stocks with overall Quadrix scores of 75 and higher. If you follow this simple approach, you are likely to find stocks with safe and growing dividends that offer above-average total returns. Rule number 3. The power of dividend reinvestment. We took the Hayford example at the beginning of the video. He'd have a lot more income today had he been able to reinvest all those dividends. Dividend reinvestment is the essential component to building wealth with dividends. Author says building wealth, not generating income. There's nothing wrong with cashing your dividend checks to pay bills and fund your expenses. For some, it's a given. But if you want to build wealth over time, cashing your dividends is not the way to go. Reinvesting them is. By reinvesting dividends, you take advantage of what Einstein reportedly called the 8th wonder of the world, compounding. It's using your dividends to buy more shares of stock, with those shares producing more dividends to buy more shares, and so on and so forth. Rule number 4. Purchasing a stock on its ex-dividend date. The ex-dividend date for stocks is usually set 1 business day before the record date. If you purchase a stock on its ex-dividend date or after, you will not receive the next dividend payment. For example, Walmart paid $0.53 per share dividend on January 2, 2020. The payment went to shareholders who had purchased Walmart stock prior to the ex-date of December 5, 2019. The company had previously declared the dividend on February 19, 2019, and the record date was set as December 6, 2019. Only shareholders who had purchased Walmart stock prior to the ex-date were entitled to the cash payment. You have to own a stock prior to the ex-dividend date in order to receive the next dividend payment. If you buy a stock on or after the ex-dividend date, you are not entitled to the next paid dividend. While this may sound unfair, remember that the stock price adjusts downward to reflect the dividend payment. Therefore, while you are not entitled to the dividend if you buy on or after the ex-dividend date, you are paying a lower price for the shares. For example, at this point you may be thinking to yourself, if all I want is the dividend, why can't I just buy the stock just prior to the ex-dividend date and sell on the ex-dividend date? In that way, I can capture the dividend payment-free money. Not quite. Remember that the stock price adjusts with the dividend payment. Say you buy 200 shares of stock at $24 per share on November 26, 1 day before the ex-dividend date of November 27, and you sell the stock at the close of November 27, and the stock pays a quarterly dividend of 50 cents per share. The stock price will adjust downward on November 27 to reflect the 50 cents payment. It's possible that despite this adjustment, the stock could actually close on November 27 at a higher level. It's also possible that the stock price could close November 27 at a level lower than the $23.50 price suggested by the 50 cents adjustment to reflect the 50 cents dividend. Let's assume, for the sake of this example, the stock adjusts perfectly, and you sell at $23.50 per share. Are you better or worse off for capturing the dividend? Well, you'll receive 50 cents per share in the dividend, but you'll lose 50 cents per share because of the decline in the stock price. So it would appear to be a wash. But what about taxes? Hence, this is not a good strategy. Rule number 5. Proper diversification. By employing diversification correctly, investors can reduce portfolio risk without sacrificing returns. Proper diversification has 4 important components. We'll discuss about each of them. Diversification across assets. Otherwise known as asset allocation, this form of diversification considers how much money to hold in stocks versus bonds and other asset classes. The goal, of course, is to own asset classes that are not closely correlated with one another. Yes, perhaps correlations are tightening between asset classes, especially on the equity side. Still, return spreads are significant enough to warrant spreading your bets across assets. Diversification within assets. This form of diversification spreads your bets within asset groups, such as within stocks. Large, small, mid-sized, and international stocks. And bonds, short-term, long-term, government, corporate, and tax-exempt bonds. Diversification across time. Investing on a regular basis spreads your bets across time. Dividend reinvestment is really a form of time diversification. By feeding money into the market on a regular basis, you avoid putting all of your funds in the market at the top. Diversification across investment strategies. Portfolio diversification can be improved by including investment strategies that are not highly correlated. Diversifying across strategies is akin to the idea of core and satellite investing. For example, if you believe in passive investing, you may take the bulk of your investment dollars and invest in index funds covering a variety of asset classes. That's the core of your portfolio. But you want to diversify your primary strategy with other investment strategies. This satellite portion of your portfolio may focus on actively managed mutual funds or commodities. Ultimately, investors are best served by looking beyond the dividend yield at a few key factors that can help to influence their investing decisions. The dividend yield, in conjunction with total return, can be a top factor as dividends are often counted on to improve the total return of an investment. Looking only to safe dividend payers can also significantly narrow the universe of dividend investments. Many dividend stocks are safe and have produced dividends annually for over 25 years. But there are also many companies emerging into the dividend space that can be great to identify when they start to break in, as it can be a sign that their businesses are strong or substantially stabilizing for the longer term, making them great portfolio additions.